Imagine walking into a grocery store in the summer of 2028. You have money in your account, your card works, the system recognizes you. But when you reach for a package of ribeye steak and scan it at the self checkout, something strange happens. The screen flashes red. Transaction declined. Not because you're broke, not because your card expired, but because the system has decided you've exceeded your monthly carbon allowance for animal products. You can buy the vegetables, you can buy the processed soy protein, but the meat, that's restricted. Your money is still there. You just don't have permission to spend it on this. This isn't a dystopian novel. This isn't speculation about some far off authoritarian regime. This is the stated goal of central banks across the Western world, and the infrastructure to make it happen is being built right now, while everyone is distracted by inflation numbers and stock market drama. The most fundamental transformation in the history of money is happening in silence. They aren't just changing the value of your dollars, they are rewriting the definition of what money is. And when they're done, you won't own money anymore. You'll have conditional access to a programmable control system. The technical term for this is Central Bank Digital Currency, or CBDC, but that sanitized acronym hides what it actually means. What we're really talking about is the end of financial freedom as it has existed for thousands of years. What we're talking about is a system where every single transaction you make is monitored, approved, and potentially blocked in real time by algorithms you'll never see and rules you'll never vote on. What we're talking about is turning cash into code, and code can be programmed. If you think your government would never do this, you need to understand something crucial. They've already done it multiple times, and every time they promised it was temporary. Every time they said it was for your protection, and every time once the control was installed, it never went away. It only expanded. In 1933, the United States government made it a federal crime to own gold. Not to steal gold, not to counterfeit gold, to simply possess it. Executive Order 6102, signed by Franklin Roosevelt, gave Americans less than a month to turn in their gold coins, bars, and certificates to the Federal Reserve in exchange for paper dollars at a fixed rate of $20.67 per ounce. Anyone caught hoarding gold after the deadline faced 10 years in prison and a $10,000 fine. That's equivalent to over $200,000 today. The official reason? Economic emergency. The banking system was collapsing. Hoarding gold was unpatriotic. It was hurting the recovery. Trust the system. This is temporary. Except it wasn't temporary. The ban on private gold ownership lasted 41 years. And here's the part they don't teach in schools. 3 months after confiscating everyone's gold at $20 per ounce, the government revalued gold to $35 per ounce. Overnight, the Treasury gained a massive windfall. They confiscated your wealth, then repriced it and kept the difference. That's not economic policy. That's theft with a legal stamp. But here's the question nobody asks. How did they enforce it? How did the government know who had gold? Simple. They had records. Every bank transaction, every safe deposit box, every registered purchase, the infrastructure of financial surveillance already existed. All they needed was the political will to use it. And once the crisis was declared, the will appeared instantly. Now, fast forward to 1971, another currency crisis. The United States was spending too much on war and welfare. Foreign governments were demanding gold in exchange for the dollars they'd accumulated. The Treasury was running out. So President Nixon did something unprecedented. He closed the gold window. He announced that dollars would no longer be convertible to gold. The link was severed. The dollar became pure fiat. Paper backed by nothing but a promise. And just like in 1933, they said it was temporary, a 90-day pause to stabilize the system. That pause has now lasted 54 years. What happened next was predictable. Without the anchor of gold, the money supply exploded. Inflation ravaged savings. The purchasing power of the dollar collapsed. A house that cost $20,000 in 1971 costs $500,000 today. Not because houses got better, because dollars got worse. And an entire generation was quietly robbed by inflation, which is just another word for monetary debasement. But here's what matters for right now in 2025. Both of those currency resets required infrastructure. They required the ability to track, control, and confiscate. In 1933, they used bank records and federal agents. In 1971, they used international monetary agreements and legal tender laws, but both systems were slow, clunky, full of leaks and loopholes. People could still use cash. They could still make anonymous transactions. They could still move value outside the system if they were smart or desperate enough. That loophole is about to close because the third currency reset is here. And this time, the infrastructure is digital, instant, inescapable. This time, they won't need agents to search your house. They won't need laws to criminalize saving. They'll just program your money to do what they want. And if you resist, your access gets switched off. This is what central bank digital currencies are actually for. Not convenience, not efficiency, control, total, granular, automated. And it's not a conspiracy theory, it's publicly stated policy. The Federal Reserve released a white paper in January 2022 titled Money and Payments, the U.S. Dollar in the Age of Digital Transformation. In bureaucratic language, it lays out the framework for a digital dollar. And buried in the technical jargon is a sentence that should terrify you. Quote, a CBDC could enable programmability features that are not present in physical currency. Programmability. Let that word sink in. What does programmability mean in practice? It means the money in your account can have rules attached to it. Expiration dates, spending restrictions, geofencing, conditional access. Let's say the government decides red meat consumption is a climate crisis. They don't need to ban steak. They just program your digital wallet to reject purchases over a certain carbon threshold. Let's say they want to stimulate the economy. They don't need to mail checks. They just inject stimulus credits into your account that expire in 30 days. Use it or lose it. No saving allowed. Let's say you donate to a political cause they don't like, a protest movement, a controversial charity, a foreign organization. They don't need to arrest you. They just flag your wallet. Your transaction gets declined, your account gets throttled, your social credit score drops, and suddenly you can't buy a plane ticket, can't get a loan, can't rent an apartment, all without a trial, all without a human decision. Just an algorithm enforcing a rule you never agreed to. You think this is exaggeration? Let's talk about Canada. February 22, the trucker convoy protests. Thousands of Canadian truckers blockaded Ottawa to protest vaccine mandates. The government declared a national emergency, and then something unprecedented happened. Prime Minister Trudeau invoked the Emergencies Act and ordered banks to freeze the accounts of anyone associated with the protests, not just the organizers, the donors. People who sent $20 to a crowdfunding campaign had their bank accounts frozen without a court order. No trial, no due process. One day your money worked, the next day it didn't. And here's the kicker. The banks complied instantly because the infrastructure was already there. Digital money, centralized ledgers, real-time monitoring. All it took was a political decision. Now imagine that same power, but permanent. built into the architecture of the currency itself. That's what a CBDC enables. That's what programmable money means. China's already there. Their digital yuan launched in 2020. It's fully operational and it's integrated with their social credit system. If your score is too low, you can't buy luxury goods, can't book high speed train tickets, can't enroll your kids in private schools. Your money is color coded. Um, Red money can buy anything. Yellow money has restrictions. Green money is for basic necessities only. It's a caste system enforced by code, and it's spreading. The European Central Bank is running pilot programs for a digital euro. The Bank of England is designing a digital pound. The International Monetary Fund has released frameworks for cross-border CBDC integration. This isn't a fringe experiment. This is coordinated global policy. Over 130 countries are exploring or piloting CBDCs. That's 98% of global GDP. The train has left the station. The question is not if this is coming. The question is what stage of the rollout we're in. And that brings us to the framework you need to understand. Because this transformation doesn't happen overnight. It happens in stages, predictable stages, stages that have been used in every major currency transition in history. There are 6 stages to the rollout of programmable money, and understanding which stage you're in determines whether you can still protect yourself or whether it's already too late. Stage 1 is the crisis creation. Every currency reset needs a justification, a reason the public will accept control. In 1933, it was the Great Depression. In 1971, it was the gold drain. In 25, the justification is already being built. Climate crisis, pandemic preparedness, financial inclusion, cybersecurity, terrorism financing, money laundering. Pick your narrative. They're all being deployed simultaneously. The message is always the same. The current system is broken. The current system is dangerous. We need a new system to keep you safe, and the new system requires surveillance. Stage 2 is the infrastructure build. This is the boring technical phase that happens while everyone is distracted. The central bank quietly develops the technology. They run pilot programs. They establish partnerships with commercial banks and tech companies. They pass enabling legislation disguised as regulatory updates. In the United States, this stage has been underway since 2020. The Federal Reserve launched FedNow in July 2023. It's a real-time payment system that connects every bank in America to a centralized clearing network. Officially, it's about speed and efficiency. Unofficially, it's the rails that a digital dollar will run on. The infrastructure is of. Most people have never heard of it. Stage 3 is the carrot phase. This is where they make the new system attractive, convenient, easier than the old way. You'll see incentives, discounts for using digital payments, instant tax refunds, universal basic income pilots, free money deposited directly into your digital wallet. No bank account required. Just download the app, scan your ID, link your biometrics, and suddenly you're part of the system. They need adoption. They need the majority of the population onboarded voluntarily, because the more people who are already in the system, the easier it is to phase out the alternatives. Stage 4 is the stick phase. This is where cash becomes inconvenient. Businesses start refusing it. ATMs start disappearing. Bank branches close. You can still use cash, technically, but it's harder, slower, more expensive. Transaction limits get imposed. Large cash withdrawals get reported. Depositing cash triggers scrutiny. It's not illegal, it's just friction. Death by 1,000 cuts. and most people, exhausted by the hassle, switch voluntarily. We are currently in late stage 3, transitioning into stage 4. The carrot is still being offered, but the stick is starting to appear. Several countries have already banned large cash transactions. France limits cash payments to 1,000 euros. Italy is pushing for a similar cap. Greece banned cash transactions over 500 euros. Spain requires ID for any cash exchange over 2,500 euros. These aren't security measures, these are psychological conditioning, getting people used to the idea that cash is suspicious. That privacy is criminal. Stage 5 is the mandate. This is where the choice disappears. The government announces that the old currency will be phased out. You have 6 months, maybe a year. Turn in your paper dollars, convert to the digital system. After the deadline, the old money becomes worthless. Merchants won't accept it, banks won't redeem it. You'll be left holding paper with no value. And just like in 1933, most people will comply because the alternative is losing everything. Stage 6 is the control activation. This is the end game. Once everyone is locked into the digital system, the programmability features get turned on, slowly at first. A small tax on cash withdrawals, a carbon credit system for luxury goods, an expiration date on stimulus payments. Each new rule gets introduced during a crisis. Each new crisis justifies more control. And because the money is digital, the rules can be updated remotely, instantly, without legislation, without debate, just a software patch. Now, here's the question you should be asking. If this system is so dystopian, why would any democracy allow it? And the answer is simple, because it won't be sold as dystopian. It will be sold as progress, as equity, as safety. Listen to how the World Economic Forum frames it. CBDCs will promote financial inclusion by giving unbanked populations access to digital payments. CBDCs will reduce crime by eliminating anonymous cash transactions. CBDCs will stabilize the economy by allowing precise monetary policy. Every benefit is real. Every benefit sounds reasonable, but every benefit requires surrendering control. And here's the part that should keep you awake at night. Once this system is in place, it's irreversible. You can't vote your way out of programmable money because the people who control the code control the voting. You can't protest your way out, because protests require funding, and funding requires transactions, and transactions can be blocked. You can't opt out, because opting out means having no access to the economy, no job, no housing, no food. You're not free to refuse a system that has a monopoly on the medium of exchange. This is why the meat example matters, because meat is just the test case. It's emotionally triggering enough to sound absurd, but economically minor enough to implement without mass rebellion. Once the precedent is set, the same logic applies to everything. Gasoline. Plane tickets, guns, alcohol, political donations, books, homeschooling, cryptocurrency, anything the algorithm is programmed to restrict. And the restrictions won't be announced as bans, they'll be framed as incentives. You're still allowed to buy meat. You just have to offset the carbon. You're still allowed to donate to that charity. You just have to accept the transaction fee. You're still allowed to travel. You just need approval. So what do you do? If this is inevitable, if the infrastructure is already built, if the rollout is already underway, what's the move? Because the window to act is not closed yet, but it's closing, and the actions you take in the next 12 to 24 months will determine whether you have options or whether you're locked in. First, understand that this isn't about picking a political side. Both parties are on board. Democrats want CBDCs for climate control and social equity. Republicans want CBDCs for border security and financial surveillance. The branding is different. The outcome is identical. So stop waiting for elections to save you. This is a central bank operation. Central banks don't answer to voters. Second, diversify your monetary exposure. That doesn't mean going all in on one alternative. It means spreading risk across multiple systems. Hold some physical cash, not all your wealth, but enough to function for 3 to 6 months if digital systems go down or get restricted. Hold some precious metals, gold, silver, assets that have held value for thousands of years and can't be programmed. Hold some decentralized cryptocurrency, Bitcoin, Ethereum, Monero, assets that exist outside the banking system and can be transferred peer to peer. And yes, hold some exposure to the traditional system because you still need to function in the current economy. Third, build optionality. The most dangerous position is dependence on a single system. If all your wealth is in one bank, you're vulnerable. If all your income comes from one employer who pays through one direct deposit, you're vulnerable. If all your transactions run through one digital wallet, you're vulnerable. Diversification isn't just about assets, it's about infrastructure, multiple banks, multiple payment methods, multiple income streams, multiple jurisdictions if possible. Fourth, understand that privacy is now a strategic asset. The less data you feed into the surveillance system, the harder it is to control you. Use cash when you can. Support businesses that accept cash. Minimize your digital footprint. Use encrypted communication. Don't link every account to your phone number. Don't post your entire life on social media. The algorithm is watching. The algorithm is learning. The algorithm is building a profile, and that profile will determine what you're allowed to do when the programmability features get turned on. Fifth, and this is the hardest part, accept that convenience is the bait. Every technology that promises to make your life easier is also a technology that makes you more dependent. One-click payments, biometric authentication, smart home integration, digital identity. Each innovation reduces friction. Each innovation increases control. And once you're dependent, once you've outsourced every function to a centralized system, you've handed over the kill switch. You don't have to reject technology, but you do have to maintain the ability to function without it. The programmable dollar is not a prediction, it's a plan that has been publicly announced by central banks, a plan that has working prototypes in multiple countries, a plan that has infrastructure already deployed in the United States. The only question is timing, and if history is any guide, the transition happens faster than people expect because it happens during a crisis. And crises have a way of appearing right when the infrastructure is ready. The grocery store scenario from the beginning of this video isn't fear-mongering, it's extrapolation. If money becomes programmable, then spending becomes controllable. If spending becomes controllable, then behavior becomes enforceable. And if behavior becomes enforceable through automated systems, then freedom becomes a permission that can be revoked. You are living through the most significant monetary transition in modern history. Bigger than the end of gold backing, bigger than the rise of central banking, because this transition isn't just changing what money is backed by. It's changing what money can do. And once that change is complete, once the code is deployed and the old system is phased out, there is no going back. The window is open, but it won't stay open forever. The time to build resilience is before the system locks in. The time to secure alternatives is before alternatives are criminalized. The time to understand the game is while you still have moves left to make. Because in 2028, when you're standing in that grocery store staring at a screen that says transaction declined, it will be too late to wish you had prepared. The system will be live, the rules will be programmed, and your money will only be yours if the algorithm says so. Now, let's talk about something the central banks don't want you to understand: the technical architecture of how this control system actually works. Because once you see the machinery, you can't unsee it, and you'll start noticing the pieces being moved into position all around you. A central bank digital currency is not just a digital version of cash. That's the lie they want you to believe. What it actually is a liability-based token system. Let me break that down. When you hold physical cash, it's a bare asset. Whoever holds it owns it. No questions asked, no verification required. It's yours by possession. But when you hold a CBDC, you don't own anything. You hold a claim against the central bank. Digital IOU that can be modified, frozen, or deleted at any moment. You're not holding money, you're holding permission to access money, and permission can be revoked. This is why the Federal Reserve White Paper specifically uses the term account-based versus token-based architecture. In an account-based system, every unit of currency is tied to an identity. Your digital wallet is not a wallet, it's an account, and accounts have terms of service. Accounts have compliance requirements. Accounts require verification. You cannot have an account-based currency without identification, and you cannot have identification without surveillance. Now, here's where it gets interesting. The system they're building has 3 layers. The first layer is the central bank layer. This is where the digital currency is issued and controlled. The Federal Reserve creates digital dollars and distributes them through the system. Think of this as the base layer, the printing press, but digital and centralized. The second layer is the commercial bank layer. This is where most people will interact with the system. You won't have an account directly with the Federal Reserve. You'll have an account with Chase or Bank of America or Wells Fargo. But here's the trick. Your account at the commercial bank is not actually holding your money. It's holding a claim against the central bank. The commercial bank is just the interface, the middleman. And if the central bank decides your transactions need to be restricted, the commercial bank has no choice but to comply. They're not independent institutions anymore. They're compliance nodes in a centralized network. The third layer is the application layer. This is where the programmability happens. Third-party apps, payment processors, digital wallets, government benefit systems, merchant platforms. Each application can add its own rules on top of the base currency. Carbon tracking, social credit scoring, transaction limits, geographic restrictions, and because it's all running on the same underlying infrastructure, all these systems can talk to each other, share data, cross-reference behavior, build a complete financial profile of your entire life. This is already happening in China. Their digital yuan integrates with Alipay and WeChat Pay, the 2 platforms that handle 90% of all transactions in China. When you buy something, the merchant sees the payment, the bank sees the transaction, the central bank sees the flow, and the government sees everything. They know what you bought, where you bought it, who you were with, what time of day, what device you used. They can track your physical location through your spending pattern. They can predict your behavior through your purchase history. They can identify your social network through your transaction graph. And they can enforce compliance through selective restriction. Let me give you a concrete example. In 2022, several regional Chinese banks faced a run. Depositors tried to withdraw their money. The banks didn't have it. So What did the government do? They didn't send police. They didn't freeze accounts through court orders. They simply changed the COVID health code of the protesters from green to red. Overnight, thousands of people who were trying to access their own money found themselves unable to enter public spaces, unable to use public transportation, unable to leave their apartments. Their money wasn't frozen. Their movement was. And without movement, you can't protest, you can't organize, you can't resist. That's the power of integrated digital systems. The currency is connected to the health passport. The health passport is connected to the social credit score. The social credit score is connected to everything else. It's not multiple systems, it's one system with multiple interfaces. And once you're in, every part of your life becomes leverage. The European Union is building the same architecture. They call it the digital identity wallet. By 2026, every EU citizen is supposed to have one. It will store your driver's license, your health records, your educational credentials, your banking information, your vaccination status, and your government-issued ID, all in one app, all linked to biometric verification. They're selling it as convenience. One app for everything. But here's what they're not saying. One app means one point of failure, one point of control, one kill switch. And it's not just Europe. The United Nations is pushing a global digital identity framework. The World Bank is funding digital ID programs in over 50 countries. The World Economic Forum has published multiple white papers on integrating digital currency with digital identity. This is coordinated, this is intentional, and this is accelerating. But here's the part that should terrify you more than anything else. The escape routes are being systematically closed because the architects of this system understand human behavior. They know that if they announce a full transition tomorrow, there would be resistance. There would be capital flight. There would be a run to alternative assets. So they don't announce it. They just make the alternatives illegal, one by one, slowly enough that people don't connect the dots. Look at what's happening to cash. The European Central Bank stopped producing 500 euro notes in 2019. Why? Because large denomination notes make it easier to move significant value outside the banking system. They called it an anti-money laundering measure. But here's the reality. Criminals don't care. They'll use smaller notes. Who actually gets hurt? People trying to preserve privacy. People trying to conduct large transactions without surveillance. People trying to exit the system. Look at what's happening to cryptocurrency. For a decade, Bitcoin was ignored. Then it was mocked. Then it was called a scam. But when it kept growing, when it kept proving itself as a store of value outside the banking system, the narrative changed. Suddenly it was a threat to national security, a tool for terrorists and drug dealers, a danger to financial stability. And the regulations started rolling in. Know your customer requirements for exchanges, transaction reporting thresholds, wallet verification mandates, proposals to ban anonymous wallets entirely. In 23, the European Union passed the Markets in Crypto Assets Regulation. It requires every cryptocurrency transaction to be traceable to a verified identity. No more anonymous wallets. No more peer-to-peer transfers without documentation. If you can't prove where your Bitcoin came from, you can't spend it. And here's the kicker. The regulation includes a provision to ban proof-of-work cryptocurrencies on environmental grounds. That means Bitcoin, the most decentralized, most secure, most proven alternative to the banking system. They're trying to legislate it out of existence. The United States is taking a different approach. Rather than banning crypto directly, they're strangling it through enforcement. The SEC is suing every major exchange. The Treasury is proposing broker reporting requirements that would treat every crypto transaction like a stock sale. The IRS is demanding records on every wallet with more than $10,000. They're not making it illegal, they're making it impossible to use without total compliance with the surveillance system. And if you're compliant, then it's not really an alternative anymore. It's just another monitored account. Look at what's happening to physical gold. You can still buy it, technically, but try buying significant amounts without filling out paperwork. Try selling it without reporting the transaction. Try moving it across borders without declaring it. Every bullion dealer reports large purchases to FinCEN. Every transaction over $10,000 triggers a currency transaction report. Every international movement requires customs declarations. Gold is legal, but it's monitored, and monitoring is control. The pattern is clear. Every alternative to the centralized digital system is being regulated, tracked, or banned, and the justification is always the same: security, safety, compliance, preventing crime, stopping terrorism, protecting consumers. The reasons change, the outcome doesn't. The system tightens. Now let's talk about the timeline, because this isn't some distant future scenario. The infrastructure is operational now. The programs are running now. The legislation is being drafted now. And if you understand the historical pattern, the final stages happen much faster than anyone expects. When the Soviet Union introduced currency confiscation in 91, they gave citizens 3 days' notice. When India demonetized 86% of its currency in 2016, they announced it at 8 p.m. and implemented it at midnight, 4 hours. When Venezuela rolled out the petro, their digital currency, they made it mandatory for all government transactions within 6 months. When Nigeria launched the Naira, they set a deadline for phasing out old notes within a year. These transitions don't take decades, they take months, sometimes weeks, because speed prevents organization, speed prevents resistance, speed prevents capital flight. The crisis is the trigger, and there's always a crisis: a banking collapse, a cyber attack, a pandemic, a war, an environmental catastrophe, something big enough to justify emergency measures, something scary enough that people will accept any solution. And when that crisis hits, the system that's already built will be activated, not proposed, not debated, activated. Because in an emergency, there's no time for democratic process. There's only time for executive orders and central bank decisions. You need to understand this. The people designing these systems are not stupid. They're not evil cartoon villains. They're highly intelligent technocrats who genuinely believe they're building a better system, a more efficient system, a safer system. They believe that programmable money will reduce crime, that surveillance will prevent terrorism, that central planning will stabilize the economy. They believe the benefits outweigh the costs, and maybe from their perspective, they're right. But their perspective assumes that power will only be used for good, that rules will only target the guilty, that control will never be abused. History does not support that assumption. Every surveillance system ever built has been weaponized. Every centralized power structure ever created has been corrupted. Every tool designed for security has been repurposed for control. Not eventually, inevitably, because power attracts the people most likely to abuse it. And systems designed for good are inherited by people with very different intentions. So here's what you do with this information: you don't panic. Panic is paralysis. You don't deny. Denial is vulnerability. You prepare. methodically, strategically, quietly. You build resilience across multiple dimensions. Financial resilience through asset diversification, technological resilience through privacy practices, social resilience through trusted networks, geographic resilience through multiple jurisdictions if possible, and psychological resilience through understanding that the comfortable world you grew up in is being systematically dismantled. The programmable dollar is the end game of a century long centralization project. In 1913, they centralized money creation through the Federal Reserve. In 1933, they centralized gold through confiscation. In 1971, they centralized value through fiat currency. In 2005, they're centralizing transactions through digital infrastructure. Each step made sense at the time. Each step was sold as necessary. Each step reduced freedom and increased control. And each step made the next step possible. This is the step where control becomes absolute, where transactions become permissions, where money becomes programmable, where financial sovereignty ends and algorithmic governance begins. The technology exists. The infrastructure is deployed. The legal framework is being finalized. The only question is when the switch gets flipped. And when that happens, when the crisis provides the justification and the emergency powers get invoked and the old system gets phased out and the new system goes live, there will be no going back, no appeal, no opt out. Just a screen that says approved or declined, and your entire economic existence will depend on staying compliant with rules you never agreed to, enforced by algorithms you'll never see, controlled by institutions you can't hold accountable. That's not a conspiracy theory. That's the publicly stated design of central bank digital currencies: programmable, traceable, controllable, and coming to a grocery store near you sooner than you think. The question is whether you'll be ready when it arrives.